Hello, this is Danielle Nesel from BMO Exchange Traded Funds. Happy Friday. Great to have you back with us. Our viewers and listeners, you guys are so awesome. You sent us in some great questions this week. We're going to get to those at the end of the session today. And as a reminder, if you have any questions today, if something comes to mind, send it in to us. There's a topic you want to see covered in future webinars, let us know. We really love hearing from you because that feedback really helps drive the content of these webinars. So thanks again. Today we have a very exciting discussion prepared for you. We're going to talk about the Canadian economy, the Canadian market, and talk about some Canadian equity ETFs that are available to you. We always start these sessions with our disclaimer. So just want to remind you, we really just want to highlight, we're not giving individual recommendations today. We're not providing any advice. These sessions are focused on education and insights about the market and the economy with a focus on ETFs. So with that, I would love to introduce our speakers and our experts today. This is a really fun crew. We have Chris Heeks, ETF expert, BMO ETF portfolio manager, joining us today. And we also have Stephen Shepard, investment strategist on our multi-asset team at BMO as well. Thanks guys for being here today. We're going to kick it off with our tools and resources section. So today we thought we'd highlight CanadianCouchPotato.com. If you haven't heard of this website before, I think you would really like it. You should definitely check it out. It's a fantastic resource. Lots of articles on ETFs, sector ETFs, asset allocation ETFs. There's a podcast. They even have model portfolios. So a good website for you to check out to further your education when you're investing. Our 1-minute ETF update. So we thought this was an interesting graph or chart to share with you. So we get this from our friends at National Bank. They have a monthly ETF report that they publish. And Chris, as an ETF portfolio manager, I'm sure you keep quite a pulse on the flows into ETFs here in Canada. Do you want to just give us some insight here on this chart?
Thanks, Danielle, and good afternoon, everybody. I think, we're going to talk a lot about Canada today. So this chart is really showing you something that we've been noticing in the market for actually a few months now, that you're seeing a lot of equity flows outside the US. So the US still has a very strong market, but if you looked at charts like this probably 2 years ago, 3 years ago, you would see a lot of flows going to the US. But now with this kind of reversal in the market with, vaccines rolling out since last November and stimulus, what we're seeing is investors looking for some other regions to provide, at least a complementary growth profile in addition to the US. So it's interesting that we're seeing certainly more flows to Canada and global equities as well. US is always going to be solid as kind of the world's largest equity market, but definitely seeing flows to other regions to participate in, recovery trades as these kind of positive factors roll out in the market with, like I said, vaccine rollouts and stimulus. So it's something we thought, it's topical to dive into Canada from that perspective a little more today.
Thanks, Chris, for that insight. So our topic of discussion today is Canada, and maybe I'll bring Steve into the discussion here. Steve, could you tell us kind of what's top of mind right now when we're looking at the Canadian market and the Canadian economy?
Sure, thank you very much, Danielle. A number of things have really caught our attention with regard to Canada. Within the asset allocation team, we have recently moved Canada to actually being a relative overweight in terms of our equity exposures in many of our portfolios, including our ETF portfolios. That's for the first time in probably a couple of years. And it's really a reflection, as Chris was saying, of the global reflation trade, and also a good reflection of just the simple fact that Canada is a very different market structure with a heavier focus on certain sectors, namely financials and natural resources, which of course includes energy and materials. But we've also been seeing some upside economic surprises in Canada. That's not to say that everything is flashing a green light. There are some concerns that are still out there, but overall, we feel that the tailwinds outweigh the headwinds against the Canadian economy and the Canadian equity market. So, like I said, we have moved to an overweight in Canada, but I think the three things that I wanted to talk to today are some of the more common concerns of what's going on in Canada, namely what's going on with employment relative to the COVID difficulties that we're having. Obviously, lockdowns continue, not just in Canada, but globally. Definitely have to talk about the housing market. It's, for lack of a better term, on fire. But I don't think it's quite as worrisome as some people might think. And then finally, the idea that basically Canada is in dire risk of being upset by rising interest rates. And without even talking about whether rates are going to go up aggressively or not, I think the Canadian consumer, the Canadian balance sheet is actually in fairly decent shape.
Great, thanks for setting the stage there. So maybe we could start with that first topic, kind of jobs and their rebound. Do you want to talk us through this chart here, Steve?
Sure. So what you're looking at is the month over month new job creation, so net change in labor. So these are the jobs lost and the jobs regained since last March. And it's a little more than a year since we actually learned what a COVID-19 virus looked like. But what we did see very quickly was that we lost close to 3 million jobs across Canada in the span of 2 months. And that pushed our unemployment rate, the yellow line, up over 13.5%. Now, we recouped a good chunk of those in the early months of last summer, where we thought, we kind of poked our head out and actually went outside again. And we saw the employment numbers improve steadily throughout last year before we started hearing about mutations and second and third waves. But as you can see, the fourth quarter of last year, job creation kind of came to a standstill and actually started reversing as we locked down again. The difference between the blue and the red, Danielle, red are part-time jobs. And if you think about what those jobs are, the jobs that are really suffering, namely in the hospitality industry, whether it's a restaurant or a bar or a hotel or a convention center, it's understandable that those are still absent. Now, the past couple of months, we've had some very strong job numbers, above consensus numbers of over 300,000 jobs a month. That actually has brought us down in terms of our overall unemployment rate to 7.5%, which is still higher than we were at pre-pandemic lows. But the good news story is that we're actually only 3,000, actually it's less than that, about, I want to say 279,000 jobs away from regaining where we were before before the pandemic started. So we've done a lot of good repair to the lost jobs. Obviously, certain people are still in dire straits and suffering, and hopefully that will be resolved as we get the vaccine further deployed. But overall, this is the fastest contraction and reinflation of the Canadian economy that we've seen since World War II. And the rate at which that has happened has driven a lot of the volatility, but we're pretty comfortable in saying that the worst is behind us and Canada's in good shape to regain its former trajectory, if not higher. And we've seen a number of other indicators that indicate that Canada is surprising to the upside.
Thanks for that, Steve. Really interesting to highlight there that full-time versus part-time jobs and the difference there. Now, moving on to the housing market, this is really top of mind for a lot of Canadians out there. Steve, you want to maybe walk us through what's on the screen here?
Sure. What you're looking at is basically the monthly housing starts as reported by the Canada Mortgage and Housing Corporation, the red line being a 6-month average. And it's important to look at a data series with a smoothing mechanism like a rolling average, because as we saw down in Texas, and there's been a number of times here in Canada, 1 month you can have an abnormal month just because of bad weather. So, looking at a data series over time is important. But what I like to point out here, somewhat jokingly, is that if I took the dates off the bottom of the screen, there is absolutely no way anybody could find a global pandemic in this data series. You can see that actual starts of new houses was even stronger in 2020 than it was pre-pandemic, with the exception of that first month in March. So the notion that, we're really seeing all these housing prices, and I think the average is about 22% year over year increase in the price of resale houses. And that term resale is important. I'll get to that in a moment. But this is not a supply issue. We're building houses about as fast as we ever have. It's just the fact that so many people so quickly have either wanted to relocate out of the city or move from a condo to a single family home, or just enter the housing market for the first time because their jobs have changed and the work from home transition is allowing them to do that. So it's not really supply that fell, it was more demand that really jumped very quickly. If we go to the next slide, we see a longer term view of what's going on in the market. And I talked about people that are getting into the housing market for the first time. A lot of that is driven by the fact that we're at generational lows for interest rates. The red line that you're looking at is the Bank of Canada qualifying mortgage rate. So this is kind of the average of the five-year mortgage rate, which is offered by the bank plus, or by the big five banks, plus that 200 basis point qualifying margin. So they add 2% on basically to what's posted right now to see how much mortgage you can afford. And it was announced last week that they're talking about pushing that up to a minimum of 5.25, or the 5-year average plus 2%, whatever's higher. So what that means is that $1 million mortgage turns into a $950,000 mortgage with this new change. But the key point here is that you can see over 30 years of falling interest rates, it's obviously inflated the price of houses. So what has that done to affordability? Because people are worried about what happens when interest rates go up. You can see since 2000, affordability has moved from just over 35% to call it 55%. And to put that into English, it means that it takes 55% of the average Canadian income to pay the average Canadian mortgage on a 2-story house. So like that obviously is a very strong increase, but the difference here that I'd point out is that more of that monthly mortgage payment is actually servicing the principal of the mortgage as opposed to servicing compound interest than ever before. So what does that mean? It means that Canadians buying houses at today's levels and interest rates are buying more of their home faster than they have before and at lower total interest costs. Now, of course, there are concerns, well, what happens when interest rates go up? Well, 80% of Canada's mortgage market is 5-year fixed, and the renewal rate on average this year is actually lower than it was when people started into their mortgage 5 years ago. So to think that the mortgage market could upend the Canadian economy in the next 12 months, I think is a little bit extreme. Obviously, there are pockets that just make absolutely no sense, and the good news is that the Bank of Canada and regulators are looking at this very closely before it becomes too much of a trouble.
So rates are rock bottom low, historic low levels. You showed us those housing prices and what's going on in the housing market. It's on fire. Steve, what does this all say about the Canadian consumer and the shape that they're in right now?
Sure, and this is one of the other things, like you hear, well, the mortgage market is out of control and Canadians are more indebted than ever before. This chart gives you an idea of a few different views of that. So if you look at the pink line, mortgages outstanding are only about 8.7% higher year over year. And if you think about that, that's a combination of more people wanting mortgages, perhaps people taking bigger mortgages, and also the price of the homes going up. Now, by comparison, I mentioned that 22% year over year rate on resale homes. If you're actually willing for a new house to be built from scratch, which by the way avoids land transfer tax as well, the national home price average is up only 7%. And that average includes regions that haven't seen the shift in demand, namely non-urban centers. So if you look at the year over year housing prices of places like Winnipeg or even Calgary, there's less of that get out of the city, get into the country factor that really drove migration. The things that make me a little bit more comfortable about Canadians is that unlike during the global financial crisis, we actually stopped buying stuff that we don't need so much. And that's reflected in consumer credit, which is actually 2% lower than it was a year ago. So people are being more responsible with their money, even though disposable income, because of lower interest rates, lower energy prices, people probably aren't driving their car as much. Disposable income is actually still 7.7% higher year over year. And that's also reflected in the fact that personal savings is still elevated as well. So what does all this mean? People are using debt more responsibly than they were probably a year ago. They've got money in the bank, and there is pent-up demand for consumer spending, all of which is supportive of a growing Canadian economy over the rest of 2021 and into 2022.
Thanks for that. I think this is my favorite of all the charts. It just really highlights the strength of the consumer right now, and the consumer is uniquely different to the last global crisis in 2009 when debt was getting out of control. Commodity prices. So Steve, Canada is overweight to commodities and materials. So maybe give us or walk us through kind of how commodity prices have changed and how that's affecting the Canadian market.
Sure. This is kind of one of three legs of the stool, if you will, of why we are liking the Canadian market, and the fact that commodities, not only are they typically a cyclical reflationary sector that outperforms during the expansion phase of the economy, and we're back in re-expansion, obviously the past few months. They also act as somewhat of a natural inflation hedge over time, and there's a lot of concern over rates and inflation, and that's probably a separate webinar altogether to talk about. But I just wanted to put into perspective here a couple of things, oil being the biggest one. We are just getting back to the levels of oil prices that we saw pre-pandemic. This is all indexed back to 100 back at the beginning of 2020. So oil is just basically back at the same price. Now compare that to where we were last April, when the front month future on a barrel of oil was actually minus $10 a barrel. You had to pay someone to take oil off your hands for a couple of days in April, and that obviously doesn't make sense in the real world, and it certainly doesn't make sense where we are now. We're actually expecting global GDP growth this year somewhere around the 6 to 7% level, depending upon whether you're looking at the IMF or the OEDC, and obviously that's going to come with rising oil demand as well. Once people get back in their cars to take vacations domestically, once we see more demand for airline fuel and just overall global expansion, that's bullish, not just for energy, but also commodities like copper. We've had a very good reflation of base metal demand as well. They're taking a break a little bit more recently, but since last year, we're actually about 49% higher versus those levels. And that's a reflection of the infrastructure theme that Mr. Biden keeps putting in the media, and also just overall global expansion. The top line is my favorite. I'm an avid do-it-yourselfer, and this I refer to as the 2x4 index. That's lumber. And that's really a reflection of the fact that getting a house not only has it inflated prices in terms of lumber demand and supply not being able to meet demand, it's also impacting how fast they can build houses. It's actually more of a materials constraint than a demand constraint. And if you're trying to build a deck sometime this summer, I suggest you place your order soon. I have friends last summer that replied they couldn't get enough lumber to complete their project on any given weekend, and were backlogged for months. But that's really reflected in lumber, which is a key part of the Canadian materials sector. And again, with strong housing in the US and Canada, that should continue into the end of this year.
The 2x4 index, I love that. I'm going to start using it. It's a good one.
Thanks.
Okay, so now let's transition to some Canadian factors and kind of how factors have been working in the Canadian market. And I'm going to bring Chris, you back into the conversation. You're one of our top experts when it comes to factors. So maybe walk us through this reopening trade that we're seeing happen and how it's affecting not only the Canadian market, but then the factors that are involved.
Yeah, thanks, Danielle. And so what we're showing you here is a few returns since October 31st of 2020 through to the end of last month, March 31st. And the reason we selected those dates is Halloween, I believe, was on the Saturday, and it was that early that next week that we started to get those positive announcements from Pfizer and then Moderna that they were having success with their vaccine trials and they were going to get pushed through from a regulatory point of view. And that really cascaded and started, it was a pretty significant factor reversal in the market. And when we talk about factors, what we're talking about is, different ways to call it assemble Canadian equities. So in the middle of the chart, you can see the TSX Composite Index, your broad beta, standard index returned about 21%. But if you assemble that index in different ways, so for example, assembling it with a dividend tilt or assembling it with a value tilt, this really kind of confirms a lot of the kind of positive trends that have been happening with respect to reopening. You can see from a factor point of view, dividends and value, we would consider them more cyclical sectors. So sectors that are more inclined to benefit from, a bounce back in returns. And to that point, we've seen ZDV and ZVC, so two of our ETFs for those respective factors, perform quite well. On the other hand, we've seen low volatility like ZLB. It's actually caught some wind in the past month in a positive way to recover, but overall it has not been as much in favor in a market that's really benefited growth or benefited more cyclical based exposure. So those are interesting ways that equities are playing out. And I tend to think we're still midway perhaps in this movement, because if you look at the factors that have driven this, number one being vaccine rollout, number two being stimulus, those things are obviously still playing out as we kind of speak today. So perhaps that could favor more cyclical sectors going forward. And here's just
go ahead.
Yeah, I was just going to say, here's an example of a dividends, and there's a couple different dividend strategies. You might be a little surprised to hear us talk about dividend as a more cyclical factor, but one thing we notice with dividends is there is a connection between dividends and value. So companies are going to have higher dividend yields when prices are low, right? Because the dividend yield is dividends divided by price. So when prices are low, dividends go up. So there's actually a natural connection between dividends and value that's pretty interesting. And what you can see here is dividends kind of on that 6-month window and 3-month window, 1-month window, year to date as well. So kind of everything from 6 months and in, you can see dividends, both BMO and iShares, but dividends in general are enjoying some strong performance. And then here's, sorry, Danielle, to jump again, but you do, same thing for low volatility, right? And there's many low volatility products in the market. Like I mentioned, for the past month, we've actually seen some really strong returns in low volatility, kind of catching up. It's been out of favor, as I said, in this growth market, but in the last month, our low volatility is up just over 8%. So starting to catch up again, but again, lagging a little bit on the 6-month, doing quite well over longer time periods.
Yeah, maybe I'll just remind our viewers and our listeners, there's a lot of different low vol strategies out there, like dividend strategies, and everybody does something a little or a lot different. So do your research, dig deep, get on the providers' websites and see how they are approaching these factors, because everyone comes at it.
Or send us an email for that matter, and maybe we can talk about it another time.
Absolutely. Here's an interesting one, Krista. We're talking about that rotation that happened after Pfizer Monday with the vaccine news. And then, of course, Canada enjoying a lot of that rotation because we're overweight a lot of these sectors. Maybe you could provide us some insights on that.
Yeah, so, much like the chart on the factors, looking at the Canadian market from a sector point of view, it's quite a similar story. So in terms of what's been performing most strongly, certainly the more cyclical sectors, the more what we would call aggressive sectors. Base metals would be top of the list. Energy, industrials, and financials. So you can see we have, there's a ZIN, for instance, industrials are performing close to 40%. Whereas again, remember the index is about 21. You'll see actually the top sector in Canada has been the healthcare, and healthcare, there's about one healthcare company, but most of it in Canada are marijuana stocks. So those have been on fire, so to speak, especially with Biden gaining office and being more, having more of an open policy towards marijuana from a federal point of view. So that's a bit of a specialized trade, let's say, but you can see, those other top performing sectors, all what we would call cyclical sectors. So oil, base metals, industrials, consumer discretionary, and banks, financials. Banks have been a very good place to be the last few months. You can see outperforming, and then on the other side, you can see more defensives. Consumer staples, utilities, telecoms underperforming, and then materials. So one thing I'd say with materials, there's a lot of gold in materials. So gold has kind of consolidated. As risk has come back on in the market, gold price has come off a bit. We've seen some consolidation in gold equities, and that's what's driving that materials sector number lower. But again, there's many sector ETFs to get to allow investors to have exposure to particular sectors, and I think there's a lot of interesting ideas that are out there.
Great, thanks for that. Do you want to talk us through some of the sector ETFs that could be available in Canada, that are available?
Yeah, for sure. And there's quite a few. I'd say BMO and iShares would be the leaders in terms of sectors. At BMO, we've always, especially in Canada, favored an equal weight sector approach. One thing you can have in a Canadian equity market is it's a relatively smaller equity market compared to, say, the US or Europe or even Japan. So you can see concentration in industries. For example, in oil, the top 3 companies, I believe, are something like 50 to 60% of the oil industry. So we've always favored equal weight ETFs. iShares tends to have the market cap weight. In an economic kind of reopening environment, one thing you get with an equal weight is you get a little more weight in the smaller companies, and that can have some positive effects. So we've seen that with some of our strategies, such as our banks outperforming the market cap financials. But overall, there's a lot of different options, and we've got, as you mentioned off the top, some tools. You can come onto our website and look at some different sectors and how they're performing. What we're showing here are more, I would say, the cyclical style exposures. So industrials, ZIN, having some very strong performance. Lumber, as Steve mentioned, that's a part of that, as well as railroads and generally economic sensitive industrials. Banks and financials, oil as well, are definitely themes that have been, seen wind at their back over the past few months.
And Chris, you bring up a great point. I'm just going to echo it one more time, that equal weight type of index versus a market cap weight index. So again, for our viewers, just be mindful when you're looking at these types of exposures, how that ETF is weighting the portfolio, because that can have a lot of impact on it. Well, that brings us to our questions. We have a few really good questions today. The first one comes from a viewer who likes utility stocks and is looking at ETFs for this exposure. And they'd like to know, should they write the calls themselves, or could they look to an ETF like the BMO Cover Call Utilities ETF and have the portfolio manager take care of it? So Chris, I'm going to send this right to you because you run our option portfolios at BMO. So what do you think?
We run both. So I think, the first thing you should ask yourself is, do you want the long-term growth of the sector, or do you want growth along with income? If you want the growth, you could just simply go into the ZUT and you get your utilities, equal weight, rebalance twice a year, very nice and clean. If you're an investor who has a higher income kind of demand, our cover call products are all yielding in the range of, say, 6 to 8% on average. ZWU, the North American utilities would be towards that upper end. I would say, it's you certainly can write your own cover calls, but I do believe it's an area where BMO Asset Management as a investment manager can really take care of a lot of the legwork for you. Just for example, today is actually an option expiry, and we're trading somewhere around about 300 options today. So, if you want to do that, God bless you, the market's there and you're more than welcome to it. But we do find a lot of investors don't mind us taking care of that legwork for them and monitoring and trading as needed. So in short answer, you can do both, but we're happy to do it for you.
And Chris, thanks for taking the time to be on Market Insights on a busy day like today when you're trading all those options. That's a lot of work. Okay, next question. Someone who loved our session last week with Kathy Wood. Well, that was a great one. We have the replay online if anyone wants to catch it, just hasn't seen it yet. They'd like to know what's going on in the tech space right now in these innovation companies. There's been a lot of volatility, a little bit of a pullback. What's the outlook here? Steve, can you speak to this one?
Sure, I'd be happy to. I get this question a lot, what's going on in tech? I think you could probably replace the word tech with the world. There isn't a single business out there that isn't driven by tech. So one person's tech, when your conversation with Kathy Wood is fascinating because it's talking about innovation technologies. What are going to be the driving technologies in the next 10 to 20 years? So themes like genomics, environmental climate change, electrification of of vehicles like Tesla, names like that, they're all very inspiring. So really thinking about that long duration future growth. Or you could compare that to the actual tech sector of the S&P 500 as defined by GICS, which are the industry sectors where you don't find a lot of those more exciting names. You find good old fashioned boring Microsoft or Apple. And then finally, the term FANGs has been popular for the past several years. Well, it's actually spread across 3 or 4 different industry sectors. So Amazon, it's under consumer discretionary because it looks a lot like a shopping mall. Well, really, it's a cloud computing company. And that's really where a lot of its growth has come from. So technology as a theme is definitely never going away. What people are seeing is some of the consolidation that Chris spoke about with regard to factors. The factor that's reflected in large cap technology was a combination of growth and momentum. And in 2020, when growth was scarce, technology were the only companies that were generating expectations of positive earnings because we were learning to work from home. We were signing documents electronically. Zoom became a verb and a noun, I think. Who's Zooming who became the question. But, in terms of technology, what we're seeing is that now that growth is more prevalent throughout the economy and also across a broader number of sectors, we're seeing that the market is rotating into more of the value factor. And that's reflected in the cyclical sectors that didn't perform last year and were actually bid down. So I think if you're a long-term investor, I think, volatility can be your friend in terms of adding to good quality technology names or ETFs or more focused innovation ETFs during this time. But I mean, technology for the remainder of the year, it's a mixed bag. It really depends what technology you're looking at. The only thing I'll say is the worst thing you can do is try to chase performance of the super high value technology names that seem to dominate the headlines. I would be cautious about some of those things. When you're looking at PE multiples with 3 digits or no earnings at all, that makes me a little nervous as a portfolio manager. But for those that have the interest in the long-term horizon, I think technology will continue to be a very investable area.
Thanks, Steve. Our next question comes from someone who wants to know a little bit about rebalancing on the BMO MSCI Innovation Indexes. Chris, that's something you work on. Can you speak to this?
Yeah, for sure. So, I think at a high level, the ARC funds, they're actively managed portfolios, as the question indicates. They're highly concentrated portfolios as well. And overall, I think it's just a different style, and there's certainly nothing wrong with a concentrated portfolio if your stock bets are doing well. The risk with concentrated portfolios, of course, is when the stocks aren't doing well, you can have potentially more volatility. So the BMO versions, I'd say, are more in line with our DNA as an ETF provider. And I would say that's kind of highlighted by a disciplined methodology, highly diversified, to reduce risk where possible. I mean, obviously these technologically oriented sectors are going to carry somewhat higher levels of risk, but we can reduce some of the risk with better diversification. So one of the things we have in our methodology is a 5% cap, so they're not as concentrated. And we also have, a lot more names, than the ARC ETFs. A lot of our innovations will have 200 plus names. And what we find in a lot of our factor ETFs and delivering our exposure is you don't have to rebalance, every month, every week in order to get that exposure. And sometimes trading too much can actually cost more money than the value it can create. So when we, test out an index for any of our indexes, we always look to try and find out what the optimal rebalance frequency is. And in this case, with our partnership with MSCI and ARC, where ARC is also partnered as part of this index, we found that a semi-annual rebalance does a very good job of capturing these exposures over the long time period. And remember, these are long-term ideas, mega trends that we expect to play out over 5, 10, 15, 20 years. And, as a result, I think as long as you're capturing companies that reflect that, then you're going to keep the portfolio in line. And so, yeah, we think, rebalancing twice a year is adequate to give you exposure to those strategies.
Great insight there. Here's another question. A common theme I hear about is about alternatives. What are alternatives and why are they a hot topic? Steve, can you take this one for us?
Sure, absolutely. Alternatives, as the name implies, is basically looking for other asset classes beyond just the typical bonds, equities, and cash that, are the basics of any portfolio. So you'll find alternatives referred to also sometimes when people talk about pension style investing, because pensions aren't retail mutual funds. They have the opportunity, particularly larger pensions like CalPERS or even CPP. You hear about things like real estate, private equity, hedge funds can be considered alternatives because they come under different regulation from the mainstream menu of investments that most people are familiar with. The idea behind alternatives is basically not just to generate higher returns, but more importantly, to offer greater diversification because they have low correlations to other things in the market. So when we think about alternatives from portfolio construction point of view, we basically look from a return and risk and factor perspective and ask the question, is this going to do something different than what I already have in my portfolio? And there's a number of investments that have come to market, whether it's via ETF or via mutual fund or other vehicle that are giving retail investors more access to these sorts of exposures. And they may not be pure play exposures. Infrastructure is often quoted as an alternative sector. You then need to look at what you're buying and say, okay, am I buying listed infrastructure? So assets that are actually available on a stock exchange already. While that, it might all be infrastructure, but the difference between listed and unlisted infrastructure is very different in terms of its contribution to diversification in your portfolio. And it also varies different based on where in the world you're looking. But alternatives are just another way to build a stronger portfolio. And we do offer a number of different.
Thanks, Steve. So diversification really being the word to highlight with alternatives, but lots of different types of alternatives out there. Read up on them. They're all different from each other for sure. Well, that's it from us today. Thank you so much for making us part of your Friday afternoon, for sending in those great questions. Keep them coming. Make sure you join us next week. We are going to talk about options. So that'll be a great one. Same time, same place. And just as a reminder, this session provided is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and or trading strategies should be evaluated relative to the individual objectives, and professional advice should be obtained with respect to any circumstance. We'll see you next week.